Welcome to Getting Rich with Rich. I'm Rich, founder of Under the Radar Report. This week, I want to drill down on what I consider to be one of the key elements to company analysis, the balance sheet. Look, you cannot go past the balance sheet when it comes to protecting your capital, but this week, I also want to talk about the benefits of protecting your capital, which is the reject shop. This has been a long-term hold for our portfolio. This has been one of the stocks we've been covering for some years now, and the stock doubled. It more than doubled, actually, after a bid from a Canadian giant. Now, look, this is one more example of what I've been talking about. Just another example, like last week it was Nanosonics, this week the reject shop. You need to own about 20 small caps that have good potential, good fundamentals, and then good things happen. Good things happen. It's not complicated. Just buy cheap and hold on, and something's going to happen. I'm telling you, it happens too often. So people make investing more complicated than it actually is. Like they do that because they're playing a momentum game. We're not in the momentum game. We're in the making money game. The big takeout here from the reject shop takeover is the fundamental gap between what the market in a steady state is willing to pay for an out of favor small cap and what a corporate is going to pay for it. And let me tell you, corporates are much less price sensitive. If they want to gobble something up, they'll buy it. I mean, it's not that big a deal for these guys, whether we're talking industry players, as in the case of the reject shop, or private equity. It just isn't a big deal. Add into the equation is that the US dollar is very, very strong. Australian assets look very, very cheap. So look, this stock, the reject shop, wouldn't qualify for many fund manager portfolios, but it's qualified for our portfolios. It's qualified for some of our dividend portfolios. What allowed us to keep the faith with reject shop was its strong balance sheet. The reject shop grew its revenues consistently, fairly consistently, albeit, low growth, but profit growth was all over the shop. Basically, we've been buyers of this stock under $3. When it got over $3, we turned holders. This happened over a long period of time. The first bull point when we covered the stock, this company has a strong balance sheet. This was front and center in our focus when we looked at the risk rating. The risk rating is very important because basically the risk rating is about protecting your capital from basically what happens when a company runs out of money, it has to raise money, then that's dilutive. You don't want that to happen. You want to know that if a company goes through bad times, then you've got protection. What's your protection called? It's called the balance sheet. Now what's happened with reject shop? We bought under $3. It's been taken over for $6.68. That's in cash. So this is tangible evidence that if you hold a number of small caps, one of them get taken out. If they don't get taken out and they keep performing well, they get elevated into an index. Either way, you're a winner. One of the first things that I came to grips with when I was an analyst, when I first started analyzing stocks, was the balance sheet. Maybe that's because my first boss was one of the top banking analysts at the time. But needless to say, that held me in good stead because at Under the Radar Report, we're looking for swimmers. We're looking for small caps that can weather, tough times. That means having a strong balance sheet. And that is the focus of this week's issue. All the stocks we analyze in this week's issue have strong balance sheet, albeit for different reasons. Many of them just happen to be manufacturers. When you're a manufacturer, the balance sheet is very, very important. The inventory levels, the debtors, the creditors, you really need to be on top of how that company's working capital is moving around, whether or not it can pay its bills, what the length of its liabilities are, and when the cash is coming in. All these things are very important. I'm talking Austal, a shipbuilder, Clover. I'm talking Gale Pacific, Nanosonics. You cannot make money from these sorts of companies if they consistently need money. They need to be strong enough to be able to withstand difficult times. One of the strongest balance sheets is actually held by a company, Integrated Research. They're basically a troubleshooting systems provider. This company has renewed a 5-year contract with a company that has the biggest balance sheet, arguably in the world, or one of the biggest balance sheets, JP Morgan. So Integrated Research is really worth checking out. So you need to do your homework when it comes to risk. Speaking of which, we've got a special report coming out for blue chip members on what to do if you're lucky enough to have a lump sum. If you sold a property, coming in inheritance, what have you. So one of the keys certainly is preserving your capital. So we focus on that, but we also focus on dividends and income and the tax benefits, and we focus on growth. You cannot maintain a steady state in your life without investments that are growing in your portfolio. That's a truism. So we add into our report the Magnificent 7 dividend paying blue chips. So that's a great start for building your core. As I keep saying, build a core, then go for growth. It's that simple. See you next time.